Hey, this is Sasha. Welcome to another episode here on Let's Talk Stocks. And in today's episode, what I'm going to do is share with you 8 and more benefits to trading options and also calendar spreads. Now, I'm doing this and sharing this with you just due to the recent course that we have released. So if we take a look here at our Options Mastery Calendars course, this course was just recently released just a couple weeks back. So we have a sale and discount on it right now. So if you want to go take a look at this on our website at Rise, the number 2 LEARN, Rise to Learn. And when you get there, you can go to our courses page, go to the options trading section, and in there you'll see some of the other option trading courses that we have available. And you can go ahead and click the calendars course, and you can see this course is still on sale for a handful of more days. So check that out. And when you get there, you can also see a video where when we actually do this video, you'll see that there's actual clips from the footage from the course. So there's actual footage directly from the course. So if you want to just take a look and get some sample footage, then go ahead, go to this page, and you can see some sample footage exactly from the course talking about portfolio, the time of the day, to enter your position, setting up a trade. So there's some great clips in there that you can get absolutely for free. So to kick things off and get things started, let's take a look at some of the reasons why you may want to trade option spreads, and more or less also some of the benefits behind them, and looking also at calendar spreads. So I'm going to start out with reason number 1. And reason number 1 is less capital at risk. So when you look at any trade or investment and you're starting to look at putting in some stock, let's take a look at NVIDIA here, for example. If you go ahead and try to buy this stock and we analyze this stock trade, well, this stock right now is $143 per share. So if you go ahead and take out a calculator and we go $143 per share and we multiply that times 100 shares, well, you're paying $14,000 to put on a trade for 100 shares. Now you can go ahead and trade this same kind of concept with options, because when you buy a stock, you're looking for a directional move. You can do the same kind of thing when we look at an option. If I just go ahead and put a calendar on, well, I could put that calendar on right in the middle. I could put that calendar on a little bit more directional, so that way as it goes up, I continue to make money, I could put it on more directional to the downside, so that way if a stock goes down, I make money. So that's kind of one of the benefits behind trading options, is that you don't have to have a single direction on the stock. You could say, hey, well, I'm slightly bullish, very bullish, slightly bearish, very bearish. So you could really adjust where you position these things out. And not only that, you get to make money every single day that stock stands still, as long as it's in your sweet spot or range, or even, let's just say I adjust it slightly bullish. So if it stands still and it slowly starts decaying over here, well, you still get to make that $10.99 per day, every day that stock stands still. And if it goes up, you're still in your sweet spot and you still make more money, as long as that white line, which is today, current line, gets closer and closer to that green line at expiration. So that's kind of reason number 1, is that putting on a spread like this with less capital in mind is that you can go ahead and play this stock for $1,000 still on a directional basis, rather than putting up a lot more cash, $14,000 versus $1,000. Now you might be wondering, well, what are the returns on that? And we'll get to that in a second. So looking at reason number 2, this is what gets me into reason number 2, is the higher percentage of return. So when we look at the return that you're going to get on these investments, so let's say I'm going to put this on bullish, just like I would with a stock. So let's say I started out kind of like this. Well, I'm risking about $872 worth of capital, okay, to be able to make, and let's just say, okay, the stock is going up to 160. And it takes a few weeks or a couple days for it to get there. It doesn't happen in an instant. So I'm going to shift the time forward. So let's say you make about $530. It could be over here. So in that case, it would be 370. It could be, maybe it's not moving that much, so you might only make 280. So let's say it doesn't move that much. Let's say about, you make 240 on 875. So when you do this, 240 on 875 is our risk, you make about 27%. Okay, whereas if you just buy a stock and it only moves, you know, $5-10, well, you're making about $1,600. Well, that's a lot more, but $1,600 on about $14,000 of investment, right? So if we look at this, $1,600 on about 14,000, what's the risk? 375. Okay, you're making only about 11%. So you're making about half that, depending on the movement, depending on time expiration, that kind of stock that you're trading. So it's all going to be a little bit different, of course, but it will vary from thing to thing. But overall, the calendar spread for an option trade, you'll be able to make more on the percentage of return. It's much higher and much greater because you're making money also from the decay of option contracts, because what you're doing here is you're selling one, okay, you're selling the near month option and you're buying a further one out that decays at a slower rate for protection. So you're selling, in a way, insurance premium on one that decays quickly, and the other one that you buy for protection decays a lot slower. Let's look at reason number 3. And this is a pretty cool reason that many people like, is you can be non-directional. It doesn't matter if the stock goes up or down. All that really matters is that you kind of stay in your sweet spot. Now, you could set up that sweet spot to the bullish side. You could set it up to the bearish side, as I've shown you. But let's say I kind of put it a little more in the middle or so. Well, now, as long as time moves forward and I stay between this 130 and 160 range, okay, so let's just say we move the day forward a little bit. Now, it doesn't matter if I go down in price and I'm at, let's say, 135, or I'm at 155. The amount that I make is where this white line is, and that could be $111. It could be $166 if I move up and I'm at 155.31. So it doesn't really matter. Now, if I think stock is going a little higher, well, I could just adjust this a little more to the upside, and now it's like, okay, well, I don't have as much room on the downside, but I have more room on the upside. And now, okay, as this slowly moves in, moves higher, well, with time, again, you keep decaying, so you make a bit more cash there. So again, that's the flexibility, is that you don't have to be directional. It's not just, you know, buying a single where, okay, it's got to go up for me to make money. That's the only way you make money in a buying position. So that's reason number 3. Let's take a look at reason number 4, okay? You make money from time decay. Now, in stocks, you don't make money from time decay. When it stands still here, you can make money from dividends. That's one thing that you can make money from, but it's not from time decay. It's from a company paying out its dividends. So in theory, it is time decay, but in general, it's really not. It's more the company is paying you out money from a share of the profits, and not every stock will do that. Whereas with options, you're making money from time decay. The 30-day option decays much faster than the 60-day option, and the 60-day decays much faster than the 90-day. So that's what you're doing here, is you're selling one right here. Let's say you're selling one at 43 days, and you're buying one at 77 days. Well, why is the closer month decay faster? Well, it's the same reason why you know, bananas decay a lot faster than apples. Well, you're trying to get rid of the bananas quicker if you're a store than apples, because they decay a lot quicker. It's kind of like going to a baseball game. If you're trying to buy a ticket and you got 3 months before the game starts, well, you could get full price probably for it. But if you're already 3 innings in, more than likely they're just trying to dump and get rid of those tickets if they have leftover tickets, because, well, eventually that game is going to expire. And then they won't get anything for the tickets. So you can definitely make some money from time decay, even if that option or that stock is really just sitting there. You're just making money as time decays. And that value is determined by this theta right here. In our case, it would be $11 a day. But of course, if you're trading more contracts, you know, or higher premium stock or options, it could be $27 a day. It could be $270 a day. It's all just relative based on, you know, what you're trading there. Let's take a look at reason number 5, and that is more flexibility. So they're more flexible when it comes to option trading than stocks. Again, you're looking with a stock, all that you can do is it goes up, you make money, goes down, you lose money. You can manage your position in the sense of when you have the number of shares. So I could have 500 shares and then I manage it by 100 shares, 50 shares, takes them off, puts them on. So you could manage it by position size, but there's not a lot of flexibility besides that. With options, what you can do is you can manage it based on the magnitude of the movement you expect or the speed that it's going. So let's say more bullish, less bullish. So I could do that. But the other thing that you can do is you can manage the time or length. So let's say you want to be in an investment like a longer term investor, just like a regular person, but you also want to make money from time decay. Well, you could still go out 300 days or 700 days and then just put on, and when that gets closer to expiration, just take that off and put another one on. You know, or if you're looking at a shorter term duration, you could do shorter term options right here. Now, the other thing is you could start skewing these things. So if I go to a custom setting, take a look at what I could do. I could slowly start rotating these and rotating the positions. So you could see now I'm skewing my calendar. So you could see I've rotated even more bullish, and I could go even further bullish. So you could see now I have much more of a, you could say, a long-term investing risk profile, which is bullish mostly, but I still get the benefit of this theta or time decay. I still make 26 a day, even though if it just stands still, because of that time decay right there. And I have a little bit of extra room right here until my break even. So you can see the flexibility is much greater because you can really start skewing these and tweaking these and rotating them based on your needs and based on the flexibility that's available here in these option contracts. So I could rotate them like this. I could go ahead and rotate them a little more like that, make them a little more bullish or bearish, or I could stack two of these on top of another. So I could stack, let's say, the 160s, and I could stack 10 of these and 10 of these. Let's see, these are March and April. Let me duplicate these out, April and March, and let's duplicate this. So I'll show you here. So I could go to the 160 here and the 160 here. So I could create two spreads, one at the let's say 150 and one at the 160. I got 10 contracts there, or I could go ahead and reduce some contracts here, and now I got some skewed positions. So you can see the flexibility behind this is much greater than you can with a stock. It just depends, hey, do I want a little more risk here, a little less risk there? Sometimes that's a good thing, sometimes that's a bad thing. It just depends on your trading style, but overall the flexibility is much greater when it comes to trading calendars or option spreads than just a stock. Reason number 6 would be to hedge or protect yourself. So let's say you have a lot of positions just like a regular stock and you're just investing in a stock, and that's fine if you have basic stock investments. Well, the thing about stock is, well, they're short, they're long delta, so when they pull back they hurt you on the delta side. So this can be a problem, but if you know how to deal with options, what you can do is set up positions to where, well, if it pulls back, well, you actually at least protect yourself. So you can learn to buy a put, or you can learn to, let's just take a look at calendar position right here, and I'm going to skew it kind of the other way. So let's say I'll go ahead and do something like this, which is a bearish position, right? So I'm making money as the stock goes down, but remember, I'm long the stock, right? And I stack this bearish position on top of it. Well, this kind of extends my break even a little bit more, so that way I'm making a little bit on my theta. Now you could go ahead and start playing with these contracts. So let me go ahead and let's say I go to about 14 and 14 here. So you can see that, okay, well, I'm still long this stock, right? Still, excuse me, on my profit picture, I'm still long this stock, but I got a little extra range here for protection, because now when this goes down, let's say this goes down to 138. Well, if it goes down to 138, well, on this stock, I lose about $2,800. That's quite a bit of money. On the option, though, it goes down to 138. I make about, well, $700. So now, hey, you make 700 from this, but you lose 2,800. Well, at least now you're only losing 2,100. And keep in mind, with the time decay, as time continues to decay, you might actually be up much more. So you might be up about $1,000. So you cut those losses actually in about half. So losing half as much is better than losing the full amount. So it's a good way to kind of hedge and protect yourself. Let's take a look at another kind of reason. Especially this one is more so geared for calendars, and that is their positive Vega. So when you look at positive Vega, and positive Vega basically just means when you're looking at your Vega exposure or your position right here, and I put this trade on, well, I got a positive Vega position. Whereas when you do a iron condor or a butterfly, you're negative Vega. So what's interesting about these calendars is that when you have a calendar position here, and I go ahead and set this up, let's say to the 150, and I reset my date. So as prices actually continue to go down with a positive Vega position, let's say volatility pops 5, which means people are in a panic, this calendar grows and the calendar expands. And when it expands, it actually helps me when prices go down, or it helps me, it cushions me a little bit. It doesn't, you're not going to end up being fully profitable right away because you still have positive delta. But overall, it helps alleviate some of the pain on the downside, especially when you have that positive Vega exposure from the calendars, which is a great benefit to doing something like a butterfly or an iron condor. It gives you that extra cushion on that downside move. So that's one of the reasons I do like calendars from that standpoint. And reason number 8 is it's a little bit of faster time decay than iron condors. And the reason for that is, it really, of course, depends on the type of spread you're putting on. But if you're putting on an iron condor, remember, the fastest decay, no matter what option you're trading, the fastest decay and the sweetest and the juiciest is always kind of at that money or at the money strikes. So if you're putting on iron condors kind of over here and then over here is the spreads you're trading, well, if you're trading these spreads way out here out of the money and you're putting on an iron condor, well, those still decay. They just don't decay that quickly, right? They don't decay that quickly. So instead, what you want to do is when you put on calendars, if you're kind of putting them around this range, they kind of decay the fastest. Now, butterflies decay very, very quickly, but calendars decay much faster than iron condors. So it's a good kind of balancing situation when you compare positive Vega and negative Vega trades, and also the decay speed, time for time on your spreads and positions. So anything at the money is usually going to decay way quicker than something out of the money, simply because those at the money strikes are the juiciest in terms of premium. So they have kind of the fastest time decay. So a couple of other quick notes and other reasons for you, maybe not mentioned here, and that is when we take a look at it, calendars expand as prices fall, which you've seen me demonstrate. Also, calendars offers diversifications to iron condor, positive Vega versus the negative Vega. And then what we also have is calendars can be short or long-term strategies. So if you're looking for longer term as an investor, great. If you want to do shorter term trading, great. You can do them with calendars as well. And you can also trade calendars on smaller or larger priced stocks, whereas kind of iron condors are a little more difficult on smaller price stocks because you need to get further out or get wider. With calendars, you can kind of do them on smaller or larger price stocks. So it gives it a little bit more flexibility there for you. And then one more reason for you is calendars are easier to adjust than some other option strategies because you're kind of dealing with the same strike price. So usually makes it a little bit easier for you in that sense. And rather than getting too complicated on moving a single leg or a broken wing butterfly, they're a little bit easier to adjust. than some of the other trades. So anyways, that's just kind of my thoughts and insights. I hope you enjoyed kind of some insights here as far as the benefits go to trading options and trading calendar spread specifically. If you want to take a look at our options mastery course, then take a look at the website there at rise, the number 2, learn.com. Like I said, it's on special and discount for the time being. So check it out. If you want to hold off and get a rain check on it, just send an email and note to us on the support section of the website, and I can hold it for you up until the end of February, even though the sale and promotion ends kind of mid-February there. So it ends next week, so be sure to check it out and get it before that time frame. Otherwise, you'll be out of luck, just like at any store. Once the promotion ends, the promotion ends. So thank you so much for joining me in this week's episode. Hope you found it helpful. I look forward to seeing you either on my newsletter list, which you can get by clicking this link here, or in one of my courses. Thanks again, and I'll see you next time.